Today we're going to go through case study 1 together. Turn to page 193 in your textbook. The June 30th and November 30th balance sheets for Lacroix Enterprises are shown below and on the next page. So on the bottom of page 193 and the top of page 194, you'll see these two balance sheets. Let's compare the two balance sheets and answer the following questions, and we'll give reasons for our answers. Here's a balance sheet for June 30th. Here's a balance sheet for November 30th. Back to June. Notice the total current assets, made up of cash, accounts receivable, and office supplies, is $115,500. Notice that the accounts payable, which is the current liabilities, is at $40,000, and the capital account is $225,000. These are the amounts on the balance sheet at the end of June. Now let's look at November. Cash, accounts receivable, and office supplies are now worth $115,000 even, a drop of $500. Let's take a look at the accounts payable. It's up to $57,000. It was $40,000. Now it's up to $57,000. And the capital account on November 30th is $214,235, which is down from $225,000. So that's a drop of $10,000. So based on this information, has the financial position of the business improved, weakened, or stayed approximately the same during these 5 months of operation? Well, we can see that the financial position has actually dropped by 5%. The owner's equity was $225,000 on the end of June, and is $214,235. So that's over $10,000 drop in the capital account. What additional information would you want to see to determine whether or not Lacroix has been successful in this venture up to now? The net income should be examined to establish whether performance shows improvement the longer the business continues to operate. So it would be nice to see the income statements for June and the months in between up to November, just to see what the net income looks like. Does the current balance sheet indicate any potential problems for Lacroix? Current assets has dropped slightly from $115,500 to $115,000. That's only $500. That's not too bad. But the big problem is that the current liabilities has increased to $57,000 from $40,000. This might give us an indication that he might need some cash to pay immediate bills, or there's something wrong with his net income that is causing him to have more liabilities that are going to be causing problem with his cash flow. Why has the value of the mortgage stayed approximately the same, even though Lacroix has made regular monthly payments? Normally, mortgage payments include interest on the loan besides principal, and this way each month the principal is reduced. However, mortgage holders, the people that are paying the mortgage, can decide to just pay interest only, or even a portion of the interest, which means that their principal does not go down, and in some cases actually goes up. So that's why we can see in some situations, after 1 year, the principal on the mortgage might actually be higher than it was when it started. Lacroix's capital has decreased. Does this mean the business has a total net loss for the 5 months of operation? We can't tell whether or not it's net loss. There could be other reasons as to why the capital account has decreased. One of them could be that there have been withdrawals taken between June and November. We haven't seen the balance sheets for July, August, September, and October, so we can't really tell. So we can't assume that these are due strictly to net losses. They could be also due to withdrawals or other investments. Your assignment today is to complete case studies 3, 4, and 5 on pages 195 and 197.